Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Q3 Market Shakeup, AI Timelines, Capital Flows, and Tech Earnings. This video presents a direct informational narration of the source document. To process recent market shifts, including semiconductor declines and tech sell-offs, the source material outlines a structured analytical approach to evaluate current financial data. We'll be looking at the AI market shakeup, the analyst's framework, expectations versus reality, tracking capital flows, catalysts and market risks, and finally decoding the noise. Section 1. The AI market shakeup. The source document details a pretty rare collective decline in the semiconductor index right before major tech earnings. All 30 component stocks fell, and this happened despite broader market gains elsewhere. So this divergence raises a critical question. Is the AI economic boom slowing down? We really have to look at the immediate trajectory of the artificial intelligence sector and the timeline of its supporting infrastructure. A major clue here is that the OpenAI CEO recently admitted his previous timeline was overly optimistic. He noted that the economic disruption initially anticipated following the release of GPT-4 simply hasn't materialized at the expected speed. As quoted in the source, the economic inertia is too massive. Society's adaptation is much slower than expected. Section 2. The Analyst's Framework. To objectively evaluate this news, the source material introduces a professional institutional methodology for breaking down market noise. This framework evaluates conditions through 6 structured pillars: analyzing business fundamentals, identifying expectation gaps, assessing valuations, tracking capital flows, and plotting catalysts against risks. Section 3. Expectations versus reality. Applying this framework to the AI sector reveals a significant expectation gap regarding technology adoption and hardware monetization. It really comes down to capital expenditure, or CapEx, which are the funds used by a company to acquire, upgrade, and maintain physical assets such as data centers, servers, and chips. Trillions of dollars have poured into data centers and chips, heavily reliant on the CapEx of the big 4 tech companies: Microsoft, Amazon, Meta, and Google. Now, if AI adoption remains slow, the big 4 have both offensive and defensive flexibility. They can aggressively cut CapEx to protect their own profit margins, but doing so would leave highly dependent downstream semiconductor firms fully exposed to abrupt, massive revenue drops. Forecasts for 2027 AI CapEx vary wildly, ranging from $950 billion to $1.7 trillion. Because of this enormous variance, upcoming earnings are absolutely critical for confirming if future hardware demand is actually real. Section 4. Tracking capital flows. Looking at capital flows, data indicates hedge funds have executed a massive and rapid reversal, shifting from buying to selling tech equities. Of the recent market sell-off by hedge funds, 47% consisted of macro products. The remaining 53% of the net selling was concentrated in individual stock unwinds. This was particularly driven by funds unloading long positions in information technology and hardware. Furthermore, the fundamental long/short ratio dropped 3.4 points to 1.61. This marks the 4th percentile over a 1-year period, signaling a very rapid defensive shift among these funds. Despite all this heavy selling, overall U.S. IT net exposure now sits at 16.6%. This is historically low compared to the past 3 years, which actually leaves room for potential leverage adjustments moving forward. Section 5. Catalysts and market risks. The primary short-term catalysts are upcoming earnings reports, which will heavily influence option pricing and sector volatility. Options markets have priced in significant price swings based on recent Friday settlements. At a 68% probability, implied earnings volatility shows expected swings for NVDA at plus or minus $13, MRVL at plus or minus $25, exceeding 10% volatility. INTU at plus or minus $31.50, CRWD at plus or minus $17, and CRM at plus or minus $17. A key risk factor right now is whether NVIDIA can continue to single-handedly shoulder the financing and growth of the semiconductor supply chain. This is coming into focus as its credit default swaps reach higher levels. Specifically, NVIDIA's 5-year CDS rates recently spiked to historically high levels, landing between 84 and 87. Section 6. Decoding the noise.
Beyond tech earnings, macroeconomic elements are also undergoing intense structural interventions in the background. The U.S. Treasury is reportedly considering deploying up to $1 trillion from the general account for bond buybacks. This is to counter shorts and prevent the 10-year Treasury yield from reaching 5%, a level which has flattened the yield curve.
As hedge funds de-risk and AI adaptation timelines stretch, the market awaits concrete data to see if the hardware supercycle can sustain its momentum without broader macro catalysts. Ultimately, the question from the source document remains: will the market's defensive rotation stall the AI hardware cycle, or will earnings provide a new catalyst?